Today, I'm going to show you an amazing scalping strategy that takes advantage of the first 90 minutes of the market open. It's called the Quick Flip Scalper. It's repeatable, effective, and best of all, simple. My name is Shabin, and I've been trading for 20 years. One of the biggest lessons I've learned is that the vast majority of the money traders make happens during the first 90 minutes of the trading day. For traders, this is our bread and butter. If you want to improve your chances of becoming a successful trader, you need to master the market open. And to master it, you need the right trading strategy. Otherwise, it's game over. In today's video, I'm going to show you how to use the Quick Flip Scalper strategy in 3 simple steps. I'll explain it exactly the same way it was taught to me back in 2011, and the same way I've taught hundreds of traders since then. We've used it consistently for years to make solid trades. After breaking down the 3-step strategy, I'll also show you how to trade it live in the market so you can see exactly how to apply it. Let's get started. I love this Quick Flip Scalper strategy. I've built a 15+ year trading career around it. Most people I teach it to like it too because it's straightforward and doesn't require complicated analysis. Step 1. Box the opening range candle. Open the asset you want to trade on a 15-minute chart. For this example, I'll use the NASDAQ 100, but the strategy works with any asset. Just make sure you're using a 15-minute time frame. Let the first 15 minutes after the market opens pass completely so that the candle closes. Once the candle closes, use the box drawing tool to mark the highest and lowest points of that candle. For example, if the high is 24,675 and the low is 24,502, connect those two levels and create a box around that range. Then extend that box into the future. And that's it for step 1. Just box the high to low range and extend it forward. Step 2. Confirm it's a liquidity manipulation candle. This is a very important step. A liquidity candle is a fast, aggressive candle moving strongly in one direction, either up or down. The direction doesn't matter. What matters is the speed and aggression. But it's more than just a candle. It's an emotional event. When traders around the world see this kind of move, their instinct is to chase the momentum because they fear missing out. That's exactly what these candles are designed to do. Pull inexperienced retail traders into the move and create liquidity for large institutions. Big institutions need liquidity to enter and exit large positions efficiently. Without enough liquidity, their trades would move the market too much and hurt their own entries and exits. That's why these moves happen almost every day. Often, these candles involve stop hunts, aggressive moves that trigger clusters of stop losses from retail traders. Those triggered stops create the liquidity pools institutions need to fill their positions. A great explanation comes from old-school trader Dr. David Paul. The best trades occur after the masses have been stopped out. Large institutions can't simply hit a button and instantly enter huge positions because there isn't enough liquidity available. So they engineer price moves that trigger retail traders' stop losses, creating the liquidity they need. That's why I call these manipulation candles. The key idea behind the Quick Flip Scalper is this. Most of the time, these manipulation candles reverse. And that reversal is the edge we're using. How to confirm a manipulation candle. If you're unsure whether the candle is a manipulation candle, here's an easy way to confirm it. Switch to the daily chart and add the average true range, a TR indicator, using the default 14-day setting. Suppose the ATR is 400 points. That means the asset typically moves about 400 points per day. Now go back to the 15-minute chart. If the opening candle's range is 25% or more of the ATR, then it qualifies as a manipulation candle. For example, 25% of 400 points equals 100 points. If the opening candle's high to low range exceeds 100 points, it's considered a manipulation candle. So if the low is 24,502 and the high is 24,675, that's a 173-point range, well above 100 points. That confirms it's a manipulation candle. Don't worry about exact precision. If it's slightly below 25%, like 22 to 23%, you can still use it. But 25% or more is a strong sign of manipulation. That completes step 2. Step 3, find the perfect entry using reversal candles. Now we move to the final step. Go back to the 15-minute chart and switch to a lower time frame, preferably 5 minutes. Though 1-minute, 2-minute, or 3-minute charts also work. I personally prefer the 5-minute chart. Now we wait for one of 2 reversal candlestick patterns to appear outside the boxed range from step 1 and within the first 90 minutes after market open. If these reversal candles don't appear, we do not take the trade. The 2 reversal patterns we're looking for are hammer/inverted hammer, bullish/bearish engulfing candle, hammer candle setup. A hammer forms after a strong downward move. The long wick shows that buyers stepped in aggressively and institutions bought into the weakness. The idea is simple. If large institutions are buying aggressively, the market usually won't continue lower. The entry is taken on the break of the next candle. The stop loss goes below the hammer low. Inverted hammer setup. An inverted hammer appears after a strong upward move. The wick forms on top, showing aggressive selling pressure. Entry happens on the break of the next candle. The stop loss goes slightly above the high. Engulfing candle setup. Engulfing candles work similarly. A bullish engulfing candle completely engulfs the previous bearish candle. For bullish engulfing setups, enter above the previous candle's high. Place the stop below the engulfing candle low. For bearish engulfing setups, enter below the previous candle's low. Place the stop above the engulfing candle high. Example trade on NASDAQ 100. Suppose the market opens with a strong bullish liquidity candle. That means we now look for bearish reversal candles above the box range. We switch to the 5-minute chart and wait. About 45 minutes after the open, an inverted hammer appears above the box. That's our signal. We enter on the break of the next candle, place the stop above the high, and target the opposite side of the box. The box serves two purposes. První, identifying reversal zones. Druhý, providing profit targets. In this example, entry 24,872. Stop loss 24,900. Target 24,610. That's a 28-point risk for a 212-point reward. A very strong risk-to-reward ratio. And this pattern isn't rare. These reversals happen constantly because institutions repeatedly need liquidity to enter and exit positions. Live market example using NVIDIA. The next day, I traded the strategy live using NVIDIA. Before the market opened, I checked the ATR on the daily chart. A TR equals approximately $8. 25% of $8 is $2. So if the opening 15-minute candle exceeds $2 in range, it qualifies as a liquidity candle. The market opened and produced a strong bearish candle with nearly a $5 to $6 range. That confirmed it as a liquidity candle. I boxed the range. Low, 176. A high, 182. Then I switched to the 5-minute chart and waited for a bullish reversal below the box. Eventually, a bullish engulfing candle formed below the range. I entered above the previous candle's high at 175.15. The stop loss was placed below the low at 172.5. The target was the top of the box at 182.3. That gave risk approximately $2.65. Reward approximately $7. Risk to reward ratio about 2.7. The trade moved sideways for a while, then eventually rallied back into the range and finally hit the target profit. It ended up being a great trade. Final thoughts. That concludes today's video. I hope you found value in the quick flip scalper strategy. It's simple, effective, and built around understanding how liquidity and institutional behavior move the market. One final reminder, past performance does not guarantee future results. Even though this edge has worked for decades, markets can always change. Some markets respond better to this strategy than others, so always evaluate the edge regularly. As always, take care, trade well, and thanks for watching. I'll see you again soon. Bye.